I'm buying $30,000 of Meta stock after its recent earnings disaster. In this video, I'm going to tell you why I'm adding to Meta right now. Am I just buying a falling knife and chasing a dip? Am I never going to get my money back? I'll tell you my thoughts on that. And I'm also making changes to my portfolio and buying more of Shopify, more of Taiwan Semiconductor, more of Tesla, more of Mercado Libre, and more of Rocket Lab. And the three positions I'm selling are The Trade Desk, Airbnb, and Advanced Auto Parts. There's nothing wrong with these companies in my position. They're great companies. I feel that The Trade Desk is a little bit overvalued for its next few years, future growth potential. Same thing with Airbnb. And then Advanced Auto Parts, just in my opinion, doesn't have the long-term growth potential of a lot of the growth stocks that I like. This is not a recommendation for anybody to follow. In fact, I recommend you do not follow me. I recommend you do your own work. Talk to a financial advisor. I'm not a financial advisor, and make your own decisions and be aware of the risk associated with it. What I'm doing is I'm sharing my investing journey transparently. Index funds and ETFs and more conservative investments are better for 95% of people. And maybe that's the lesson I'm going to learn through this whole thing if my portfolio fails and goes to zero over the next 5 or 10 years. What I really want to focus on today is Meta, right? Stock's down 23% on downgrades. Going to talk about those, missed earnings, and big spending on the metaverse, right? So we talked about the negatives. I did a video yesterday on covering the quarter. They actually beat on revenue, but they missed on EPS, and they talked about spending more money on AR in the metaverse and Oculus and all this stuff. And everybody hates that right now. Everybody hates Meta right now, which is exactly, if a company's not dying, and I am bullish on long-term what Meta is doing. I'm going to share why, some quotes from the earnings call. If the sentiment is extremely negative and everybody hates it, that's how you can outperform long-term. And that's what I think is going to happen over the next 5 to 10 years. You could see right here, these are the consensus estimates for earnings per share. You can see they've come down since February, right? But they were pretty level all the way from June to the end of September. But then after the earnings call yesterday, you could see this steep drop where EPS estimates, or the consensus estimates, have come down significantly for 2022, 2023, and 2024. Same thing has happened with revenue estimates. These have come down as well after yesterday, right? So expectations are just so negative on this stock. Also, you can see analyst price recommendations and price targets. And so since October 24th, we've now gotten 4 downgrades to Meta share prices. KeyBank downgraded it. Morgan Stanley gave it a price target. They dropped it down from 205 to 105. Cowen dropped down from 205 to 135. Bank of America dropped down from 196 to 150. Okay, and they'll probably come down further. Who knows? And so what I want to talk about is Meta compared to Twitter, Google, Amazon, and Apple, right? Let's zoom out a little bit and talk about perspective. First, we know Meta's getting crushed year to date, down 61%. Twitter's actually up 23% because of all the buyout stuff. Google's down 34%, Amazon's down 30%, and Apple's down 15%, right? But over the last 10 years, and really I don't think it's been quite 10 years yet, but Meta over its time frame is up 491%. Versus Google up 461% over the same time frame, and then Amazon and Apple are still significantly outperforming. So all that to say, even with the crazy drop, with how bad Meta has done over the past 5 years, and it's been horrible, the shares still aren't doing that horribly over a longer term time horizon. Then again, if we get into price to earnings expectations, the PE ratio, if we look 3 years out, and these are going to change obviously, but just look at the difference of Meta compared to these other companies. And what I have decided is I would rather own Meta at this valuation and these multiples than Google, Amazon, and Apple at their multiples. That's the decision I've made. I could be wrong about that decision, and so far I have been. But if we look 3 years out, the non-GAAP price to earnings multiple is 10.52 compared to Google at 14.52, Amazon at 30, and then Apple at 21, right? So again, I just can't justify owning Apple. I think it's actually overvalued compared to Meta, which I think is extremely undervalued. People are talking about the death of Meta. This company is horrible and it's not going anywhere. Well, the stock price is certainly horrible. But if we look at the revenue growth, this is how much they have grown revenue at a compound annual growth rate over the last 3 and 5 years. They've grown at over 3 years. We'll go 3 years. They've grown at 24%, Twitter at 16%, Google at 22%, Amazon at 24%, and Apple at 14%. Meta is not dying. They've grown revenue Over the last 5 years, CAGR at 29% versus Google at 21, Amazon at 26, and Apple at 11%. That's not what a dying company does. Gross profit margin, 80%. Google's at 56%, Amazon's at 42%, and Apple's at 43%. Net income margin, 28% versus 23%, 2%, and 25%. Total cash per share, this is just insane. $4.70 in cash per share for Meta versus $1.69 for Google, $3.68 for Amazon, and $1.71. Meta, by all metrics, is not a dying company. What they're doing that everybody hates is they are using the cash flows from their established, profitable advertising business that's reaching a point where it's not going to continue to grow nearly as much, but it will continue to produce cash. They're using that cash flow and doing what no company and no CEO, almost no CEO has been willing to do, which is take a risk and invest in creating the future of the business with a legacy business. No CEO is willing to do that type of thing in general because A, they'll get fired most of the time, but Mark Zuckerberg has the voting rights and the ability to do this, which could be an extreme risk, right? And then the other reason they won't do it is because it's going to crush the stock price, which is exactly what's happened. But if it pays off, this is how you create the next generation, the future of a company. All right, let's jump into a couple quotes from the earnings call that show just my thoughts and I mean, really what the CEO and the management team is thinking. Okay, and what they're seeing is just headwinds in the economy, which is hurting the advertising business at the wrong time while they're making these investments, right? And that's really unavoidable, and every company is feeling this type of thing. It's not clear that the economy is stabilized, so they're planning the budget somewhere more conservatively. I like that. 3 areas that they're going to focus on our AI discovery engine that's powering Reels, other recommendation experiences, ads, and business messaging platforms in the future vision for the metaverse. I like that they're narrowing their focus. The current surge in CapEx, this is what everyone has a major issue with, is all the money they're spending, is largely due to building out our AI infrastructure, and we would expect CapEx to come down as a percentage of revenue over the long term. We expect Reality Labs expenses will increase meaningfully again in 2023. That's what set the stock in this crazy death spiral of down 23%. And this is, again, what no one does. Our capital allocation philosophy over the long term is to allocate a portion of the profits generated from a family of apps towards these future-focused areas while enabling a greater return of capital to shareholders. Okay, and Reels is actually doing pretty great. 140 billion plays across Facebook and Instagram, a 50% increase from 6 months ago. It's incremental to the time spent on apps, so it's not taking away. And that trend looks good. They believe it's gaining time spent on competitors like TikTok. What if TikTok goes away in the United States? We'll see. Okay, and then Zuckerberg talked about monetizing WhatsApp and Messenger and new types of ads where you get direct to message ads. It's basically one of their fastest growing products at a $9 billion run rate. Click to WhatsApp just passed a 1.5 billion run rate and it's growing at 80% year over year. Show me how many companies are growing a product line at 1.5 billion at growing 80% year over year. Not many. They're starting to get into paid messaging. So there's even innovations happening on the advertising side of the business, right? And then the metaverse, right? It's not some crazy idea. I saw an article talking about how metaverse is just going to be how we use the internet in the future, much like how e-commerce is just a part of commerce now, or the internet is just how we do things now. It used to be these big crazy things, and it's almost like the article called out that we're going to stop calling it the metaverse, and it's just going to be how we use the internet, right? So they called out there's 200 million people who get new PCs every year, mostly for work, and their goal with Quest Pro over the next several years is to enable more and more of these people to get their work done in virtual and mixed reality, eventually even better than they could on PCs. They've announced partnerships with Microsoft, bringing their suite of productivity and enterprise management services to Quest, Adobe and Autodesk, bringing the creative tools, Zoom to bring a communication platform, and Accenture to build solutions for enterprises and more. So that's what the metaverse is about. I mean, there will be a gaming aspect for sure, but they are investing to build the next computing platform of the future with AI, an AI engine behind it. That's where a lot of this infrastructure and these investments are going. And they don't want to be reliant on the Apple App Store because that has absolutely crushed their business and many others. The other thing, and I'll just do another video at this point on it, but Shopify's up 7% pre-market. I am adding to it. I do own the stock. And basically they came out and they beat on non-GAAP earnings per share. They beat by 5 cents. It was still negative. And then they beat on revenue by 30 million. And they talked about cutting costs, and that's what people like. So again, e-commerce isn't dead. And I'll do another separate video on Shopify.